Hey, it's Rav. Welcome to the Everyday Investor TV show, the show that teaches all of us how to grow our money. Each week, we bring in an everyday expert to teach us, everyday people, a different strategy. Remember, whenever you're offered any type of investment opportunity, you always want to ask 4 questions. 1, what is the return on investment? 2, when do you get that return along with the money that you put in? 3, what is the minimum investment amount needed? And 4, what is the risk? What is the downside? The reason we do this show is because often the challenge is that we take our precious time, we go to work, we get paid in order to provide. You ask, what's the challenge? Well, if we have a job, we're blessed. I really believe that, but wouldn't it be great if money could make us money? You could take that precious time and you could spend it with family, friends. You could engage in a purpose that's greater than yourself, still keep your job, have a hybrid of both. Thanks so much for watching. Don't go anywhere. We'll be right back. On this week's episode, we talked to Barry McCullough, teaching us how we can make money investing in land development.
So if it's an investor that might have just invested in the 2 previous projects, let's say they were both high-rise deals in downtown Toronto, we would probably try to find a project for them that might be a different developer partner, a different part of the city, or even a U.S. project or a different asset class, just to kind of make sure that they're properly diversified.
Hey, it's Sarah Larby here. Did you know that if you are selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, 0 commissions. Head over to our website, everydayinvestor.com, to find out more.
Hi, it's Steve Aho at Canada's Mortgage Choice. Like many of you, you were probably taught, as my wife and I were, to put money into registered funds, RRSPs, TFSAs, RESPs, and those kinds of vehicles. And about 5 years ago, we learned that you can actually use those funds on secured first and second mortgages and make double-digit returns of anywhere from 10 to 11%, maybe as high as 12, and experience registered fund growth using those strategies. If you want to know more about that, please contact Canada's Mortgage Choice and myself, and I'd be happy to take you through the mechanics of how to get that done.
Hey, it's Rav. A few years ago, I learned how to trade stock options by taking the Theta trading course. My son, my friends, myself, all of us benefited immensely by applying their strategies, and I want you to have that same benefit by taking their course as well. I'm not receiving any monetary benefit whatsoever by telling you this. It's just that, as you know, I believe that knowledge mitigates risk. Visit their site to find out more. Hey, it's Rav. Welcome back to Everyday Investor. We're talking about how we can make money investing in land development. We're talking to my good friend, Barry McCullough from Greybrook Realty Partners. Barry, great to have you on the show with me.
Thanks for having me, Rav. Great to be here.
Yeah, I mean, we know each other for quite a while now. We're actually associates at Greybrook, and it's been a great ride. It's an incredible company, some really great principles. We get to different kind of investments, but today we're going to specifically talk about land development. When somebody asks you, Barry, they say, Barry, what is land development? What does that really mean when it comes to what we do? Of course, it can mean many things, but kind of, give me the broad picture of what land development really is.
Sure. So we use that term, I would say, to kind of collectively define the process of taking land, in our case, it's primarily in the GTA is kind of where our core market is, and sort of taking it through what I would call sort of 3 different stages of development. So, initially you'll have to go through, various planning milestones with the city or the municipality. It could be something as simple as a zoning bylaw amendments. It could be multiple layers to that, depending on kind of how raw the land is, so to speak. But really, it's taking it through the planning approvals, taking it through the sales and marketing program, where we'll actually do a pre-construction sales launch for a condo project or low-rise homes, whatever the project type might be. And then finally, that third stage actually shovels in the ground, delivering the the end product and turning over the keys of a finished product to a homeowner. So that sort of start to finish process is what I would say what we kind of collectively call land development.
Okay, so yeah, no, thank you for making it very simple. So there's the planning part. So we acquire the land, and then there's the planning component. There's the sales and marketing, and then there's the actual construction itself. Kind of, again, it will depend if we're building a master plan community, like Greybrook is doing in Fergus, Ontario, if you will, or if it's a few condominiums. It will vary in terms of how long it takes, but generally speaking, if we acquire a piece of land, how long does that planning process, pick one, for example, I mean, whether it's in Durham or Hamilton, or how long is the planning?
Sure. Yeah, so again, it kind of depends, like I said earlier, about how many milestones there are to go through. If we're talking about, like, let's say, an infill townhome site, you might have a couple acres of land that you'd find, within the existing urban boundary. That could be as short as maybe 6 or 9 months, right? Those are kind of rare gems to find, but in most cases, we prefer to buy lands that do need a bit of planning work. It's often where you drive a lot of the value in land development. And it would range from, I would say, a year to 4 years in some cases. The Fergus one that you mentioned, Rav, is probably a pretty good example of longer term. But in a project like that, you're buying land for effectively a nickel, and it's worth $1 after going through those milestones, and then you actually capture that construction margin, building out the homes or townhomes or whatnot. But in the case of the GTA, it's not a very straightforward process to go through that. Luckily, if you're a firm or partner with partners that can navigate that process, it's a bit of a barrier to entry, I would say.
Yeah, and listen, all the deals are great. Infill 2-year deal is great, but so is the 7, 8, 9, 10-year deal. And then I'm personally, my family and I, were invested in the Fergus project, which was an 18-year deal. And I'm 11 years into it. But sometimes I find even the longer, the greater the return, because what you're saying really is we're taking that land, we go through the 3, 4, 5, 6 years of planning. So we're already making money there, then sales, and then in construction. So from here to there, I'm making some great return per se, although it's not necessarily cash flow, it's capital appreciation. You mentioned partners. Talk a little bit about, the partners that, well, first of all, what's Greybrook's role between, the investor and the developer? Because, it's kind of, from layman's terms, we use words like general partner and so on and so forth, but layman's terms, they kind of brokering this and overseeing it. But talk about Greybrook's role and the significance of the partners that someone like Rav gets to partner with because of Greybrook.
Yeah, absolutely. So Greybrook, I would say, plays more of an asset management role. Sort of at the outset of a project, we'll identify potential acquisition site. We'll do our underwriting on it to make sure that it meets our sort of risk return profile and various checklists that we have. At that point, we'll go out there, bring the opportunity to our investors, and we'll raise capital. And then from sort of the closing of that offering, through to completion, whether it's a 4-year project, 5, 6, 7, whatnot, Greybrook is effectively co-managing that project alongside our partners. So our partners, some of the top developers in the GTA in the US that we work with, they're ultimately responsible for the execution of the project. It doesn't mean that we necessarily give them, free rein and say, okay, talk to us in 3 years and let us know how it turns out. We're shoulder to shoulder with them, especially on those, major decisions that might have an economic impact on the project. But ultimately, who you partner with is critical to the success.
Yeah, and it's not like we're partnering with, my cousin Vinny. We're partnering with the biggest players, in North America that really could do the deals on their own. But obviously, wisdom says, why not have partners? You can do more deals. And again, I don't want to can't go through all of them, but we're talking with the biggest ones that have big books and develop. I get to partner with these guys because of Greybrook. No, it's great. And so, talk to me a little bit about the different asset classes. Like you mentioned townhouses, and now we're mentioning a master plan community. Go through some of the different types of projects that I could invest in with Greybrook.
Yeah, so they kind of fall into a couple of different categories. Not to be confused with how I would say earlier, land development. There's what we call pure land development plays. In a project like that, it's not necessarily the plan to take it through a full construction and build cycle. In most cases, it's taking it through the planning milestones in the city, getting it to what's called a draft plan approved status, and then selling those lands. They could be service lots, for example, for townhomes or detached homes, selling that to a different developer, right? Just capturing that value creation in the planning process. We mentioned kind of low-rise housing. That really captures anything from townhomes, various formats, detached single-family homes. Getting into the condo asset, you have mid-rise or high-rise condos, and you could have a project that might be a single-phase, one-tower condo. You could have, one like we closed late last year, which was a multi-phase 4-tower condo project. And then in the U.S., we have a focus on a couple select markets like Atlanta and Denver and Miami on multifamily. So still a development project, but what the actual asset that's being built is often a purpose-built residential apartment or mixed-use kind of office and residential building. A bit different risk-return profile there. On a project like that, you're taking it through, building it up, leasing it up to an occupied status or stabilized status, and then essentially selling that to an institutional buyer. So a bit different exit strategy, a bit different risk-return profile, but those kind of capture the various asset classes that we get involved with.
Yeah, no, that's great. And typically, how many? I mean, obviously, we need to. When I say we, I'm talking Greybrook. We're not just doing any deal for the sake of, hey, we need to do 20 deals this year. Obviously, the numbers need to work, and there's a huge team. I mean, where you're sitting right now, I think there's 80 to 100 people, part of the Greybrook team, in-house lawyers, outside, people looking in that Greybrook wants for them to look in. I mean, there's a lot of analysis, a lot of underwriting to just make sure that the numbers work. Typically, Barry, how many kind of deals are we looking to do in a year if there are great deals?
Yeah, that's one of the most frequent questions I would say that I get from new investors. It would ebb and flow. It really depends at how many projects kind of meet our criteria in a given year. Like you said, we don't go out there trying to do specifically 20 deals every year. It really kind of depends on the pipeline. Historically, it's going to average, I would say, maybe 4 to 8 projects in a year, sometimes a bit more, depending on how the pipeline unfolds. But we're in I would say, a lucky position where we're not, we've never really been in the mindset to do a deal to just do a transaction.
Yeah.
Right? So it's sticking to our guns, making sure that we, are conservative and thorough in our underwriting. And if that means that it's only 3 deals or 4 deals in a given year, then that's what it is.
And, for an investor, it's kind of like, wow, once you get a taste of this, there's sometimes, I think disappointment's not the right word, but it's hard to get into these deals, right? I mean, by the very fact that and we're going to take a look at, the questions that we always ask, the return on investment and when do you get it and all that kind of stuff. But I don't know, 6, 7, 8,000 investors over 30 some countries. It's once you get into these, a lot of people want to get into them, but we can only take, so much. How do you deal with that with your friends, families, clients? Just a sorry, try to get you in the next one?
Hopefully not, but sometimes that's unfortunately the answer. It's definitely a bit of a challenge because like you said, they do tend to fill up quickly. Ultimately from our perspective, especially with our clients, we want to build a bit of diversification and balance within their portfolios. So if it's an investor that might have just invested in the 2 previous projects, let's say they were both high-rise deals in downtown Toronto, we would probably try to find a project for them that might be a different developer partner, a different part of the city, or even a U.S. project or a different asset class, just to kind of make sure that they're properly diversified. But yeah, I think you mentioned, Rav, we're in a position where it's pretty healthy demand amongst investors, so it can be a bit tricky to accommodate all those that are interested, but we try to do our best.
Yeah, no, it's great. And I love that word you use, diversified. We're going to take a quick break here. But when people ask me, Rav, don't you want to be diversified? I said, I am diversified. I'm working with different developers. I'm in townhouses. I'm in a master plan community. I'm in a condo. So you can, diversify. You can be in Canada. You can be in America. So no, it's great, Barry. Thank you so much for being on the show. We're going to take a quick break. We'll go through some numbers on how we can make money investing in land development. Don't go anywhere. We'll be right back.
Hey, it's Sarah Larby here. Did you know that if you are selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, 0 commissions. Head over to our website, everydayinvestor.com, to find out more.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey everybody, at Everyday Investor, Costas Cavalis is back to bring you the best pre-construction opportunities from First Access Condos. Now, everybody should know Hogs Hollow. It's one of the most prestigious areas in the country for real estate. And it has it that they have not had a brand new condo project in over 20 years. Well, we're gonna put an end to that. We're bringing you YCS, located at the northwest corner of Yonge and York Mills. This 2-tower project is surrounded by golf courses. It is steps to the 401, a stone's throw to Midtown, just south of North York City Center, and it is located in a fantastic area with multi-million-dollar homes. First condo in 20 years. Now, if that's not enough to pique your interest, what if I told you it had direct underground access to the subway and GO? So you have the 401, GO, and the main subway line in Toronto, all at your doorstep. Fantastic opportunity. Don't delay. Coming end of February. First Access Condos. Don't be second.
Hey, it's Rav. Welcome back to Everyday Investor. I'm talking to my good buddy, business associate, Barry McCullough. Barry, thanks so much for being on the show with me. Appreciate it.
My pleasure. Thank you, Rav.
Yes. So let's talk about numbers. So what's in land development? What's kind of the ROI I can expect? I mean, again, depends on the deal, but kind of what's our targeted projected returns?
So I'd say we typically aim to be able to double our investors' capital in about a 5-year window, or shorter if we can. So effectively about a 20% kind of annualized ROI is essentially what we would target on most of our projects.
And you use the word annualized as opposed to annual, because this is not necessarily a cash flow play, right? Explain that. I'm kind of, in the business of making a widget. It's just called housing. So when Rav invests his, $50,000 into a project, it's not like it's spitting me out money. Let's say it's a 4-year project. I'll get my money at the end. Yes? How does that work?
That's right. So it's a bit different than investing, let's say in an existing apartment building or other kind of cash flowing or income producing assets. If you sort of conceptually think about how the cash flows take place in a development project, obviously you're raising capital, you're buying your land, you have soft costs to cover as you go through your planning and sales and marketing phase, and then subsequently into construction. So, we're not structured as a monthly or quarterly income investment. It's rather a capital growth strategy. So really, it's primarily at the end of a project. And I'll say, the substantial completion of a project is probably a bit more accurate. Let's say we have a condo development. To use an illustrative example, let's say there's 100 units in the building. We're not going to wait until that 100th unit is sold and closed on to start distributions back to our investors. When you start construction, you're going to be at least 70% sold in many cases. Kind of sell through your inventory as you go through your construction program. But when we're in a position to then distribute back to investors, we'll do so. And if it means that there's 2 or 3 units that are left to be sold and they might sell in the next 3, 4, 5 months, you might get a couple sort of residual or minor distributions thereafter. So that's kind of the timing of the distributions. It's primarily at the end when home closings are taking place and we're kind of capturing our revenues and profits as a development group.
And then again, it depends on the deal, but when do we get that principal along with the money, the investment along with the money that we put in, our principal capital? You just mentioned, it might be staggered in the last year or 2, but I guess it just really depends on the deal. I mean, we've done deals that are 2 years and we've done, doing a deal that's 18 years. So I guess it just really the answer is the end of the project. Is that the right answer?
Yeah. Primarily, but to use your Fergus, I mean, 18 years is definitely an outlier in our portfolio, Rav, as you know, but even one that might be, let's say, 8 or 10 years, those are usually where you're doing, large master plan communities. Those will get broken up into multiple phases. So it doesn't mean that you're waiting 10 years to see your capital come back. In most cases, about midway through, you'll be done your sales and your construction on that first phase. And essentially what you have is, from year 5 onwards, as phase 2 and phase 3 and so forth finish, you'll have distributions that get paid out to the investors in those kind of interim years. So, on a shorter term project, that might be just a single phase. Again, I kind of use a condo as an example. That's primarily at the end. As you get into those larger sort of master planned communities, you'll have multiple phases and multiple distributions that typically will start about midway through.
So completed, but you get, different phases. And it's true what you're saying, even about with the Fergus project, because I've already had 3 or 4 distributions because phase 1 was complete and now we're moving on to phase 2. And so, yeah, you're correct there. What's the minimum, because these projects, Barry, these projects are 4, 5, 6, 7 and beyond $100 million projects. But little old Rav can get into these deals as low as what?
25,000 is the minimum amount for any of our projects.
Okay.
That's right.
So 25,000, and in many cases, depending on the size of the project, we can use registered funds, correct? RSP, RESP, LIRA, TFSA.
That's right. Yeah, I would say in almost all cases, there are a few rare exceptions, but in almost all cases in our portfolio, they'll be open for any kind of registered plan, whether it's LIRAs, RRSPs, TFSAs. And our team is available to help investors get that process started to make that seamless.
No, that's great. And then the question that we always need to ask, what would you say is, risk or kind of downside, the downside of investing in land development? I mean, I know one right away is, not all developers are created equal. You've got to make sure that there's a great reputation in whom you're partnering with, because really, again, as far as the investor is concerned, Greybrook is the asset manager. They're overseeing. They're kind of the in between, if you will. But I'm the investor is joint venturing with the developer. So you got to make sure that you have a great partner in what you're doing. That could be a risk, not with Greybrook because they all obviously vet and work with the best, but just in general. But what is some other risks or downside when it comes to land development?
For sure, great question. And I think, for a lot of investors, particularly if they're only ever been exposed to investing in, let's say, mutual funds or stocks or other, I'd say broadly available options or investments, it'll be a bit different with us. As you said, Rab, it's about a 4 to 7 year kind of average window for many of our projects. Sometimes it'd be a bit shorter, sometimes a bit longer. But the important thing to note is that it's an illiquid investment, right? So there's no secondary market that exists where you can buy and sell your Greybrook investment. So you have to be able to think about Greybrook as a part of your broader portfolio. Might be 5%, 10%, whatnot. But for that smaller portion, you're exchanging illiquidity, for an outsized return potential. So that would say is one kind of key risk to keep in mind is that it's an illiquid investment.
Meaning, I can't put in my $50,000 and then push a button and get it back out per se, because it's development. It might be extended a little bit, so on and so forth. And I've found in the past when it does get extended, I'm making more money. Because over time, God's not making any more land. it increases in value over time. And so, okay, that's a great point. Anything else that comes to mind?
I was just going to say the timeline, right? So again, if you kind of look back, and I mentioned earlier, sort of the three broad categories: you have your planning, your sales, and your construction. We'll look in our experience, and in aggregate, we'll say, okay, a project we expect to take 6 years or 7 years or whatnot. That's an estimate. It could be shorter than that. It could be around that time. It could go longer for a number of reasons. So again, being comfortable with some fluidity in the exact timing of the investment. It's a bit different than like a GIC, or exactly what day that's going to mature on. And sort of the analogy that I would give to many investors is, if you've ever done a home renovation and your contractor says it'll take 3 weeks, might go 4 quite easily. I mean, it's a very simplified example, but if you think about the complexities involved in the developments of the scale and size that we undertake, that potential exists too. So again, tying back to why we see ourselves as a portion of someone's portfolio, not designed to be, someone's primary investment strategy, for those two primary things, because it is illiquid, it is a bit longer term. So again, a bit different than if people were historically used to investing in stocks or mutual funds.
Yeah. Yeah. And the other thing I think about is that, kind of, we're not buying the land and necessarily thinking, oh, it's going to be 50 years before we can get permits and zoning and so on and so forth. I mean, Greybrook, with their partners, development partners, are acquiring land that's pretty much ready to go to start the process of getting permits and planning and so on and so forth. Yeah?
That's right. Yeah. And to my point earlier, when I talked about sort of the different planning milestones, and that's a very good point that you raised, Rav. There's a spectrum of land that you can buy, and there's a spectrum of players that take part in this business. And there are those that look at highly speculative plays, which might be, I'm going to buy farmland that might be on the outskirts of a city and expect that, okay, I'll buy it for a nickel, but maybe the city will expand over the next 5, 10, 20 years and whatnot. And hopefully it expands in my direction. So at some point in the future, these lands will become residential. And it's a very asymmetric outcome, right? So it's just a risk profile that for us and our investors, we don't really feel comfortable with getting that level of entitlement risk. We'll look at lands that are designated as residential or for future use as residential. And again, it doesn't mean that there's not various planning milestones to navigate through, but we don't play in that very high risk, high reward arena of pure land speculation.
And, Mama always told me, when you have more demand than supply, you're in business. I think everybody knows now, but just in case they don't, what are we expecting in the GTA, Barry, in terms of the amount of people that are moving in? And we're in a predicament where we can't keep up. We can't build houses fast enough. We have about 30 seconds, but what are your thoughts on the scarcity of housing in Toronto area?
Yeah, it's already in quite a scarce position. I don't see in the short to medium or even in the longer term, looking out many years, I don't see that problem or that equilibrium solving itself quite easily. If you think about just from the demand perspective, Rav, if you think about immigration for a second, many years ago, as recently as like 2017 or 18, Canada was welcoming about 300,000, 350,000 people per year. And now it's become to a position where 500,000 is kind of that new baseline, and factoring in that about 30% of those people that come to Canada are going to find themselves in the GTA, coupled with a hard to solve supply issue. You can see why we've been bullish on the GTA market for many decades, and still believe it's a very good place to invest.
No, it's great. Listen, Barry, it's great to have you on the show. It's great for me personally to be able to work with Greybrook, to work with great guys like you. Thank you so much for doing the show with me. I really appreciate it.
My pleasure, Rev.
And thank you guys at home for watching. Without you, we would not have a show. If you want to get these episodes directly into your inbox, go to everydayinvestor.com and sign up. Until then, we'll see you next week. Same place, same time. Honey, I love you. I'll be home soon. God bless everyone.